clearly the quadruple witching is a big story, and as you alluded to, it's the third biggest contract expiry that we've seen non-December in the history of the contract. So it's going to be interesting, and it's a big amount. But I also think a lot of the strikes are, barely inside the pin risk, as we say in the option market, i.e. they are not close enough. There's only about 2 million contracts overall, but it is a big thing. And classically, we've seen that when you talk about what happens from here onwards, classically, again, we see that inside the next week, there's a bit of weakness when all this gamma goes off the book. But, as we know from the retail stories that we've seen over the course of the last couple of weeks, the retail space has been big buyers of calls on the S&P 500. So it'll be interesting to see what happens in terms of behavior when this goes out this afternoon.
Steen, there's been a lot of commentary about what a rough week it has been, weathering concerns around a second wave of infections. But if you look at what the markets have done, from Wall Street on the S&P 500 to European stock markets, they've actually been gliding higher to the tune of just over 2%. So it hasn't been a bad market yet again for stocks. What do you make of that sentiment where investors are getting some bad news? There's some concerns around the impact, yet stocks keep on bouncing.
Well, Trump is seems to be right, isn't he? He's reopened the economy and whatever. No, but the real story here is, Karen, that we see the biggest combined fiscal and monetary stimulus in history. If you take it to the relative size of the actual markets, it's multifold of that. Of course, that drives it higher. And not least, we have to admit that the market, although we are trying to make it a very precise science, is really about sentiments at the end of the day. And that sentiment has been driven higher and higher on valuation. But what really concerns me in the short term is that if we look at all the sectors and the relative sectors, all of the speculative signs are there. If you look at the high quality, high turnover, momentum, all of these are trading at relative values of free standard deviation. And as you know, free standard deviations only happen in 1% of the time, roughly. So it's been giving a good boost. But I think also in terms of why the market is a little bit concerned or confused is that the impulse from the policy response is what we've just been going through. Now we need to go through the actual impact on the economy as we start to get July numbers for the Q2 in terms of reporting. But more importantly, when all of this furlonging and checks in the mail runs out between July and 1st of September, we will only see the real impact on the economy in Q4. So for me, this is very much a waiting game and just accepting that this is more about psychology than it is about facts.
Steen, nothing makes me happier than when a guest starts talking about pin risk. It warms the cockles of my heart, but I'm going to have to leave that aside for now. I want to talk to you about the dog that hasn't barked, and it hasn't barked for years, but there are people like Steen Jakobsen at the Institute of International Monetary Research who think that inflation could really bark in the next couple of years because of the increase in the supply of money. Huge increases in the States, huge increase in the UK and elsewhere as well. I know that CPI risk at the moment is not a clear and present danger, but for the future, do you see any risk of what Steen Jakobsen is worried about, the increase in asset values across the board, high inflation because of what's happened?
Yeah, and add to the equation that we have this localization theme or deglobalization overall, which I think is going to be the real catalyst first off, and then you're going to have the impact from the size of both the fiscal and the monetary. Yeah, absolutely. One of the plays I have right now is to increase the allocation to commodity trading because, of course, that embeds an inflation hedge. So for us, we are really looking at two new, not really new, but new sort of asset to including our portfolio going forward. And that is net long volatility at all times, because as we saw in the Mars crisis, you cannot protect yourself from anything in terms of correlation in assets except for volatility longs. And then commodity long, Steve, because exactly as we don't know with the timing, but we know from prior experiences historically, it can take 2 years, it can take 2.5 years before the inflation comes through. But absolutely, inflation is on the radar for us.